Hey everyone, this is David Aframi with BAM Advisory Group. Really excited that you're joining us today for our first quarter Meet the Asset Manager webinar. So really excited to have Jamie Huston of Bristolgate. Bristolgate is one of our favorite asset managers. It's the asset manager that we use for large cap growth and dividend. Jamie's just going to really spend about 15 or about 20, 25 minutes taking us through Bristolgate's strategy, who they are, why they do what they do, and then of course we'll do a little Q&A at the end. Just a little background with Jamie. He's been with Bristolgate for about a half a decade, and he's really their business development go-to person for the U.S. So really, don't want to waste too much of everyone's time here. Just without further ado, Jamie, I'm going to pop off and let you kind of take over.
Thank you very much. Thanks, David. I'm really happy to be here with you guys today. So I do cover the U.S. Because we are actually a Canadian-based asset manager. We're based in Toronto, Canada. David won't hold it against me that our Raptors beat his Warriors, but I'll leave it at that. So I do have a couple slides here that I wanted to share just to give you a little bit more color on our firm and why we do what we do. And then we can go to some Q&A at the end. So our firm is based in Toronto, Canada. We're independent and employee-owned, so we'd like to think that we're invested alongside of our clients and you guys as well. We are $2.8 billion in assets under management, and that's up from when I joined the firm about half a decade ago, $1 billion. So we've seen some really nice growth, and a lot of that has been in the U.S. Because of what we do as a unique piece of the portfolio. And so what we do that's different than a lot of dividend strategies out there is we try to identify the highest dividend growth companies at the highest quality. And dividends are a very popular place to invest in the market, but what we do is different because a lot of dividend strategies will look and say, how can we give you as much income as possible today, but oftentimes those dividends don't grow. And so you might just get, $5 per share in perpetuity. Whereas what we look for is we might start at a lower point and say, okay, $1 of dividend today, but in 5 years we have, 5, 6, 7 on the way upward. And we try to build a high yield on cost, which we'll get into a little bit more. But if you can think about what our strategy does, it's kind of like an apartment building. And the video on the next page will help explain what it is that we do. And David, I'll just get you to tee that one up, please.
Bristolgate is in the business of finding stocks that grow their dividends by a lot each year. If you think about it like a real estate investment, it would be like having tenants that are happy to pay rent increases every year, not by a little, but by a lot. Now imagine there's an apartment building with 22 units for rent. This is a very high-quality building, and the landlord raises the rent by at least 15% annually. While that might seem like a lot, the interesting thing is that there are a lot of great tenants out there that would be happy to pay 15% more each year to stay in such a high-quality building. So when a tenant is unable to make the increased payment, the landlord removes them and replaces them with another high-quality tenant. If you think about the value of this building with its growing rental income of over 15% annually, you would have to think that, all else being equal, it would have to rise as well. Here's why. With no growth, that $1,000 rent remains $1,000 in perpetuity. But with 15% growth after 5 years, the income stream has doubled. The value of the building will reflect that. Now, instead of a building, think of it as the Bristolgate portfolio of 22 stocks which have increased their dividends over 20% on average annually since inception. Get the picture?
So really the idea is that if you have this apartment building that has a growing stream of income over time, there are going to be periods of time over time the building is going to increase in value because of the growing income stream. It might not increase every single year because, for example, there might be a recession and broadly property prices go down. But over time, if a building continues to increase rents, the value of the building is going to increase over time. And so this graph this chart really shows you why we do what we do and why we focus on high dividend growth, the highest part of the dividend growth market. It's really, if you had gone back and look and purchased the best dividend growth stocks each year for the last 20 years with perfect foresight, this is where you would be on a risk-adjusted basis. And if you think about the last 20 years, you have the great financial crisis, you have the beginning of a pandemic, you have falling and rising interest rates, you have falling and rising oil prices, and yet as a asset class, as a part of the equity markets, the highest quintile of dividend growers it has been a really good place to be. And one reason why this is similar to what we do is our portfolio, and part of our investment process is to use a machine learning model that looks forward over the coming 12 months to help predict the best dividend growers, basically trying to identify tomorrow's best dividend growers today. And so that kind of acts very similar to the way that this chart shows, of trying to invest in the best dividend growers each year. And you can see here the level of dividend growth that we've been able to deliver. So since our inception in 2009, we've delivered almost 20% dividend growth annually. So we're growing that income by 20% each year. And even in such challenging years like 2020 or 2009, where dividend growth was very, very hard to come by, we've still been able to source really high dividend growth. And so this is really on the bottom an example of what we're looking for in a company. And so our portfolio is 22 holdings, 22 companies that we believe have the ability and willingness to deliver kind of between 15 and 20% dividend growth. And this is what it looks like when you have a company like this. So when we purchased this company 5 years ago, it was paying $1.88 dividend and had a current yield of 2.1%. 5 years later, the dividend has grown 24% annually to now $5.44. So you're getting more income in your pocket each year. It's built up a yield on the original cost of 5.5%, which is a higher yield than any sort of typical dividend fund. And the nice thing about a company like this is that the current yield still is in and around 2 to 2.5%, which implies that the stock price and the dividend growth move in the same direction as each other. Maybe not the same at the same rate all the time, but over time they do reasonably mimic each other. And you can see that in the graph above as well. The lighter line is the dividend per share, and the bottom line is the price return. And what you see is that they basically end up in the same place, but you get a much smoother ride if you're focusing on dividend growth and the dividends themselves. And so when you get moments like we've seen over the last 3 months, where the markets have gone up and down and kind of all over the place, the ability to just focus on the dividend growth and know that you're going to get to a very similar destination allows you to kind of ignore or try to drown out the noise as best you can. And this is kind of the way that we think about it from a company perspective. So we're really trying to find companies that are able to we're trying to buy companies in that red zone, that high dividend growth period. And so we'll try to buy them in the early stages as they've reinvested in their business and they're starting to generate so much cash that they're able to then continue to give more and more money back to shareholders each year. And as we start to see that dividend growth roll over, that starts to be kind of the canary in the coal mine, where we say, okay, this company is maturing. This company is getting to a stage where they're going to have to either reinvent themselves or they're just going to be a mature company. And so it's easy for us as a pretty concentrated portfolio to go back and say, let's try to find a new company at the bottom of the S curve and replace it. And this is kind of more around how we fit within a portfolio. And I know that generally speaking, balanced portfolios are what most people have in the equity markets, and we're not the be all to end all within the equity market. We're just a sleeve of a good quality equity portfolio. And you can see here, there's always going to be those dividend strategies like we were talking about, where there's that 3% yield but limited dividend growth, and then there's going to be those kind of growthier strategies that have a lot of kind of the hot high flyers, the Facebooks, the Amazons, the Netflix, the Googles, and names like that don't pay dividends. And we fit really nicely in there as a kind of a growth part there, but more of a defensive growth. And so we generally aren't holding the same stocks that the value and kind of high dividend yield portfolios are holding. We're not really holding the growth portfolios, what the growth portfolios are holding, because most of those strategies don't really care about dividends. And you can see here, and we don't really like to talk too much about performance because it's more about the process that gets you to the place. But we have been able to give you competitive returns to the S&P 500 while never holding a FANG stock, because FANG stocks, for the most part, don't pay dividends. The only stock that does, of the Facebook, Amazon, Apple, Netflix, and Google, the only one that does pay a dividend is Apple, but it doesn't grow its dividend at a high enough rate to be considered for our portfolio, and therefore we've never held one. And yet we were still able to give you a competitive yet diversified return from what the S&P is. And if you think about the biggest companies in the S&P, a lot of them are these companies, and they make up a big portion. So they drive a lot of the return. And I'll just touch a bit upon our investment process, because I think it's worth focusing on, because it is unique. So our portfolio is a 22 holding portfolio. That's where we end at, and it's equally weighted. But we start with all the companies in the S&P 500, and actually maybe this is a bit of a better graphic. We start with all the companies in the S&P 500, so there actually are 505 companies, go figure. But then we take only companies that pay a dividend, and then they have to have 3 years of dividend history. And we also eliminate companies that do not have investment grade debt, because it's an easy way to take risk off the table. And we take that opportunity set that's left over of 326, and we put them through our machine learning model, which, as I mentioned, predicts dividend growth over the coming 12 months and ranks them from 1 to 326. And then we take the top best 65, and that becomes what we hand over to our fundamental portfolio managers, who work that list down from 65 to 22. And then what they're doing when they look at that list of 65 is they're trying to evaluate the business quality, and trying to determine, are these companies that have a competitive advantage? Do they have a strong moat around them? Are they in an industry that actually is of quality and with kind of bigger growth tailwinds behind them? And then when they also look at valuation, because you can buy a great stock, but if you're not buying it at a great price, it's not going to be a good investment for you. And then the last part is the portfolio fit, and trying to make sure that everything fits well together in a diversified portfolio. And when you're looking at something as specific as high dividend growth, there are going to be places you're not going to find high dividend growth. And some of those might be, say, energy or utilities or real estate as an example, because just by the nature of the types of companies in those sectors, you can't find high dividend growth there, but you need to build a diversified portfolio. So we spend a lot of time, and this is where kind of that data science component comes back, in terms of trying to determine what are the best 22 stocks that fit together. And so that's really how we work our way down a list from 65 to the 22. And then on a quarterly basis, we rebalance the portfolio back to equal weight. And what you end up getting out of the portfolio is these traits, really. These companies have structural growth behind them. They're dominant franchises that really have, I would say, in some ways, control of their own destiny because of the way that they operate. They're generating lots of free cash flow to give back to shareholders. They're value creating reinvestment. They're reinvesting back. The first thing they do with a dollar is reinvest back in their business at a higher return on invested capital. And then they still have enough cash to give back to us. Obviously, they need to have an effective management team and that are focused on us as shareholders. A low payout ratio, meaning they're not paying out a lot of the cash that they're generating, so that there's lots of runway for them to continue to pay out more and higher dividends. And then strong balance sheets is fairly obvious, but then also consistency in their ability to deliver each year. And if any of the companies within the portfolio aren't able to meet any of these traits, then it's likely going to trigger us to watch and perhaps make a change in the portfolio. So with that, maybe David, I'll bring you back in and see if you have any follow-up questions.
Yeah, no, that's great, Jamie. I think, for our clients, what they understand is, we build diversified portfolios, and like you said, this strategy that we've used for years works great for that growth bucket. But yeah, I think there's some questions that some of our clients have. First question is, so in the first quarter of this year, obviously it's been pretty volatile. Mm-hmm. And I don't know, like, inflation has been a pretty big impact on returns and volatility. How have you guys digested this inflationary period? And,
Yeah.
and number two, has it affected the way that you guys look at companies and do your rebalancing?
Yeah, I mean, for sure, inflation is certainly something that's been impacting the portfolio, the economy broadly, and I would say that what we try to do in the companies that we invest in is try to buy, as it says on the screen, dominant franchises that are able to pass like higher input costs down to the consumer. So I mean, in that respect, it's impacted us just as much as the economy, but on a relative basis, we're trying to find companies that can do better in that sort of environment. We actually went back and looked at a study and said, okay, how have that top quintile of high dividend growers performed since 1970? And it actually the findings do come out to be high dividend growth does quite well in inflationary environments. When you think about some of the companies, right? I mean, we have Visa and MasterCard in our portfolio, and those are companies that charge a percentage on every transaction. And so if the value of the goods go up, then technically speaking, they're making just more money on the value on the back of inflation. So it hasn't. We're really trying to manage around it. We have had a few names in the portfolio that have been more impacted by it than others. But having a dominant franchise allows you to pass on those costs down to the consumer, which is helpful for the companies. In terms of how it's affected the performance of our portfolio, it's been less around inflation, and I would say it's more around a lot of companies, particularly if you look at like the factor of profitability in the first quarter. It's probably been one of the worst performing factors this year. When you think about our types of companies that are able to deliver high dividend growth year in and year out, those are very profitable companies. And so, we've seen a lot of, I guess, babies getting thrown out with the bathwater, because anything growthy has sold off considerably relative to kind of the more of the value oriented names or energy names, and growth and profitable companies have just kind of been taken along for the ride as well.
Okay, great. I appreciate that. Then of course, you hear a lot of, next question, you hear a lot of talk about, the feds are behind the curve, and I'm not asking you to predict the future. My clients know that I don't predict the future. We have, each of my clients has a plan, right? So we're not panicking about, the first quarter of this year. Actually, we've been, advising some of our clients who are sitting on cash. This is a really good entry point, which I want you to talk about, putting money to work, the entry point now. But, you hear things like if they raise interest rates now, they don't raise them fast enough or too fast, we could potentially go into a recession. I mean, how are you guys looking at, the feds and, making sure that they're not, driving the economy off the cliff? And maybe how would you guys maybe from a standpoint of, okay, we might need to rebalance the portfolio or put different companies in. Can you talk a little bit about like those perspectives?
Yeah. Well, the first thing I'll say is, we look at it as an opportunity as well. And as you're talking about rebalancing, like one of the things that's inherent to our process is that we rebalance back to equal weight quarterly, and what that causes you to do is really trim down on your winners and add to your losers on a kind of a systematic basis. And the good thing is, if you have high conviction in every part of the portfolio, whether it's the managers or the other asset allocation pieces as well, you're in fact going to generate more return by making these rebalances over time. So as we look at it, times when you're supposed to add to a manager are when they're behind, not when they're well ahead. And unfortunately, psychology leads a lot of investors to do the opposite. So that's generally our view. And so we look at it as an opportunity just as much as we feel, perhaps bad that, we trail the market on any given point in time. But, in terms of where we're going, of course, we can't see the future either, but we're trying with our machine learning model, but we haven't gotten quite figured out yet. But you know, I think it's probably at a certain point we may get to where it become challenged, where interest rates are going to have to go up to try to rein down inflation. And if the Fed does get a little bit ahead of itself, you know, it may end up we may end up getting into a recession, which quite frankly isn't the end of the world, because I think we've seen a pretty long cycle here a little bit, and it's just natural to have some air let out. And quite frankly, if you get into a recessionary period, quality and companies that generate a lot of cash are places that you want to put your equity money, because they're kind of a more safe haven than anything that's sort of more kind of speculative.
Okay, great. No, we appreciate it. We want to make this short and sweet. So thank you again for being a partner for us, for our clients, being transparent, being able to come in and, just talk about Bristol Gate and answer some questions in a tough, volatile market. We could have easily cherry picked this and done the webinar at the end of 2021, but that's not how we do things here at BAM Advisory Group. So again, appreciate your time. And ladies and gentlemen, when you watch this, if you are interested in, maybe putting some money to work that you're sitting on, or, if you don't have Bristol Gate in your strategy in our next coming review, you want to, allocate. It's a good time to allocate to a strategy like this, because you're taking advantage of a lower price point. Definitely call or text the office, and then we'll have that discussion. Anyways, Jamie, take care up there in Toronto.
Thanks very much.
I hope things are getting warm, and we'll talk soon. Thank you.
Thanks a lot. Take care.